We want to thank you again for tuning in to our Retirement Education Center YouTube channel, where on this channel, we believe in providing you unbiased advice that will help you maximize your retirement income. Now, of course, Andrea, on our channel, we certainly do not believe in providing you any type of silver bullet strategies or glorifying any type of one product. But on this channel, what we do believe in are holistic concepts that will help you retire with confidence. If you are a federal employee, you perhaps may be participating into what we call a thrift savings plan, or also known as a TSP account. Now, I've helped many clients with these types of retirement plans, and they're very similar to a 401k. But one of the things about a thrift savings plan is that it has limited investment options for many employees to choose from. So today, what I am going to be discussing are 6 major pitfalls that you're going to want to avoid if you are participating in a thrift savings plan. And I just want people to understand this may be crossover also with 401k plans as well. So if you have a 401k plan or a thrift savings plan, you're going to definitely want to stay locked in today. Hi, I'm Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrew, because with so many retirement concepts out there, so many retirement strategies, and of course, with so many retirement products, it can become very difficult for consumers to digest it all. That's why we're so fortunate to work with a team of expert advisors to help us build a financial roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, I don't hear a lot about thrift savings accounts, but many federal employees do contribute to them annually.
Absolutely, Andrew. You know, TSP accounts or thrift savings plans are built for federal employees. And to be quite frank with you, when it comes to defined contribution plans, thrift savings plans is the largest in the world with over $558 billion in assets. And so I've helped many clients operate in and out of these type of accounts. And today what I hope to do is to be able to articulate 6 pitfalls that you're going to want to avoid when you're actually, putting money inside of a thrift savings plan. And these are some of the pitfalls too, Andrew, I may add, that many people make when it comes to their 401ks as well. So if you're operating inside of these accounts, today is going to be a good lesson for you. But before we get into our lesson today, there are always 2 rules to retirement income that we like to give you. And Andrew, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
All right, so let's talk about some of these pitfalls that you're going to want to avoid when it comes to your thrift savings account.
So Carson, pitfall number 1 is not contributing enough, correct?
Absolutely, Andrea. And this goes without saying for any retirement plan that you're contributing to, not maxing out or not getting up to the match that your employer is offering you. And so when it comes to a thrift savings plan, that's also a pitfall that I see many people fall into. The thing is that when you actually sign up for a thrift savings account, the old rule of thumb is that they used to start you out automatically putting in 3% of your annual income. But as of October 1st of 2020, they actually changed that automatic contribution amount for your annual income to 5%. So you may be getting the match and not even know it, because they automatically enroll you into a 5% percentage of your income going into that thrift savings plan. Maybe for your own good, perhaps. Now, you can opt out of that and do less, but I would highly encourage people not to do so. Because here's the thing. I want you to take a look at a quick analysis for someone who perhaps would opt in to their thrift savings plan, but opt into doing only 3% as opposed to doing the 5% match, because you're basically turning down free money when you decide not to do up to the match that your employer is giving you. So let's take a look at the screen. I want to show you a quick analysis of how impactful this can be, Andrea, if you decide to maybe skirt a little bit from your retirement savings ability. So take a look at this. Just imagine if you have an income of $50,000 a year and you're going to be contributing to your thrift savings plan. Of course, your employer is going to match you 100% of what you put in of your annual salary. So let's say you decide to opt into doing 3% as opposed to the 5%. So if you have a $50,000 salary, if you take a look at the screen here, that $50,000 salary at a 3% matching is going to be $1,500 a year going in for you, and it's going to be $1,500 that your employer is also going to match you, okay, 100%. So therefore, you're going to be receiving $3,000 annually into your thrift savings account. Let's also say that you're going to retire at age 65. In this scenario here, let's also assume hypothetically that your thrift savings plan is going to average about 6% per year over that period of time. Well, as you can see, we've already done the calculation on the screen here. That's going to give you almost $480,000 when you get ready to retire at that particular age. And let's take a look at the second scenario here. This is going to be alarming. Same scenario, you're earning $50,000 a year, but instead of actually doing a 3% match, you're going to do 5%. You're going to take 5% of your income and actually put it into your thrift savings plan. Now, in this case, that means $2,500 are going to be going in for you, and $2,500 from your employer is going to be going in for you as well. Now you're putting in $5,000 per year in that thrift savings account. And lo and behold, look at what happens at age 65. That account value has literally gotten to almost $800,000 at that particular time. In the exact same scenario, the return is still 6% per year. Almost a $320,000 difference in value just because you decided to do a little bit more and take your retirement savings a lot more seriously. You would have actually put in another $320,000 of growth into this account just by 2% difference in savings. So that's alarming. And this is why many people, I look at this as a major pitfall that they just cannot fall into, shortchanging themselves when it comes to retirement planning.
So Carson, pitfall number 2 is when you are 100% investing in the G fund. What is that?
Good question, right? So if you're participating in a 401k, you have no idea what this is. There are some crossovers here that we could talk about, Andrew. So take a look at the screen here. I want to show you there are 5 different funds that if you participate in a TSP account or a thrift savings plan that you can contribute to. As you can see, the first fund that we're going to talk about is the C fund. The C fund is a fund that actually basically includes the S&P 500. So that's really what the C fund is. It's like an index fund that is the S&P 500 that you're going to be tracking, okay? Then you have the F fund. That's another fund that we're going to make sure that we try to help our clients get out of. The F fund is more or less like a US bond fund. So you're basically investing in bonds. So it's a more conservative strategy as well. The G fund, the one that you have in question, is the one that we see a lot of clients contribute money to because it's basically guaranteed, Andrew. Those are funds that are backed by the US government, like US Treasury, short-term bonds, that sort of thing. That's really what the G fund encompasses. And then you have the I fund, which is basically an international fund. And then you have the S fund, which is more or less comprised of small caps and mid cap US companies. So you have these 5 funds that you can contribute to. And the mistake that people make, Andrew, typically is really in a market like we're seeing now. They start to get afraid of the volatility that is taking place and decide to put just too much money inside of that G fund. That's a major mistake because although you're going to certainly lessen the impact of a down market, it's going to be less volatile. You're not going to lose money in a G fund. But here's the thing. You're going to open yourself up to a different type of risk, which is inflation, because the G fund will not be producing the type of returns that's going to be conducive for you to actually retire with the growth that you're going to need. So just to put this in perspective, I've actually printed out the returns for this year of each of these funds. But I just want to talk about the G fund compared to the C fund, which is more or less like the S&P 500. That's really what most fund managers are trying to outpace, so to speak. They're trying to beat the S&P 500. But when it comes to the G fund, over the past 5 years, if you had to put your money in the G fund, Andrew, it would have averaged 1.93% over that period of time. In comparison, the C fund would have averaged you 13.62%. So just imagine that if you're actually trying to have the expectations of your dollars to produce for you as you're saving while you're working, imagine the difference in returns that you've actually given up by simply allocating too much money towards this particular fund, family. So make sure that if you're working with an advisor and you have a thrift savings plan, that you're working with an advisor that can help you accomplish some sort of retirement risk goal that's going to be comparable to where your dollars should be allocated, and not have you make the decision to put all of those dollars in such a conservative strategy inside of that TSP account.
So pitfall number 3 is that you assume the life cycle fund is the right fit.
Yeah. Another mistake, right? Along with having those 5 sector funds that we were talking about, Andrea, you can also choose from what we call a life cycle fund. A life cycle fund in the TSP account is similar to a target date fund that you will see in your other retirement plans, like a 401k. And basically, a target date fund is kind of like lazy investing. It's like putting your money on autopilot. It's what we call passive investing, to where they assume that when you get into this account based on your particular retirement date, it'll be more aggressive when you're younger, and then all of a sudden, as you get older and get closer to retirement, it'll start to rebalance itself and it'll get more conservative. But the problem with this type of strategy here is that although you have a plan on autopilot, at some point you will need someone to land that plane, right? And that can be a dangerous situation, to not have someone in the seat trying to land that plane in various markets. And so when I say that, let's just imagine, Andrea, when you get closer to retirement, this particular target date fund or life cycle fund is going to assume that everyone has the same amount of risk tolerance and their retirement goals are equal, and that's just not going to be the case always. And so you're going to want to work with a qualified fiduciary advisor to help you understand what you should be doing at that particular time, and perhaps maybe just having that money on autopilot is not the right solution.
Carson, pitfall number 4 is choosing your TSP fund based on past performance.
Yes, that's another pitfall that you do not want to fall into. And quite frankly, and this is a pitfall that many people fall into, right? When you're looking at any type of investment, and that's not smart. We understand that a lot of times, we want to look at a mutual fund and we look at their 10-year history and we say, wow, it's average, 10.5% of the last 10 years. And we look at that and say that's a viable choice. That's what I want to average for the next 10 years. But you can't look at the past and try to base what's going to happen in the future. That is a cardinal rule when it comes to investing, that past performance is no guarantee of future performance. And so the real thing that you want to do, Andrew, in this situation is sit down with an advisor who can help you understand what you should be picking for that TSP account based off of your particular risk tolerance and your particular individual retirement goals.
Carson, pitfall number 5 is when people are taking loans from their TSP account.
Yes. Taking loans from your TSP account or your 401k, whatever retirement account you're saving in, is always a bad idea. One in particular, Andrew, if you're younger, obviously under the age of 59 and a half, you can subject yourself to an early withdrawal penalty of 10% if you absolutely leave that company. So that's the thing that you don't want to do. So the second thing is that if you also leave that company and you have not paid that loan back, then you're going to have to be subjected to those dollars being fully taxable at your ordinary income tax bracket as well, along with the 10% early withdrawal penalty. So the biggest thing that I look at when you're taking a loan is that money needs to be sitting into that account operating efficiently for your retirement goals. But the part about taking a loan is really not paying it back. Take a loan from these accounts. The one thing you want to make sure that you do within the adequate time that is set for it to be paid back, that you pay it back. Because one, as I mentioned, you don't want to be taxed on those funds, and two, you certainly don't want to be hit with an early withdrawal penalty of 10% because those funds have not been placed back into that account. And nevertheless, if you're taking that money out, for things that are illegitimate, like a vacation or a new car, things of that nature, that is just not very smart. And you need to speak with someone to at least help you get your budget in order, Andrew, so that taking loans from any of your retirement savings is not going to be the first option that you're going to have to do anyway.
Now, Carson, the last strategy, number 6, is when you clearly don't have a strategy for your TSP.
Yeah. And this goes for any account. I know we're talking about thrift savings plans today, but whenever you're investing in any account, whether it be your 401k, your thrift savings plan, you need to have a coordinated strategy behind what you're doing. And we've talked about this. You want to make sure you're speaking with an advisor, a qualified advisor that can help you coordinate your TSP account with your other outside savings, your other non-qualified investments, your other Roth accounts, maybe perhaps, your other individual IRA accounts, whatever it may be. You're going to want to make sure that you have a coordinated plan that's actually in lockstep with what you're trying to do with that TSP account. Because, Andrew, when you actually do retire, you don't really want to have to be scrambling for what you should be doing at that point. You would have already had a coordinated plan in place, and all you would have to do is take those funds and apply it to your original plan, update the scenario, and you already have the roadmap in place. And all you would have to do is just drop those funds where they need to be appropriately according to your risk tolerance and your goals at that time, and continue doing what you had purpose to do when you started saving in that retirement account.
Carson, that was some really good information, especially for those with thrift savings plans. So thank you for your insight on this topic, and thank you for watching. And if you feel that this information was beneficial for you, please like this video and share with others.
So I really hope that the information that we discussed today was beneficial for you if you actually are participating in a thrift savings plan, and will help you avoid some of those pitfalls. Please remember that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these type of complex financial matters, we highly recommend that you utilize the links in the description below and go ahead and schedule a free 1-hour consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.